Well, thanks for choosing GoldSeek.com radio. Today's special guest, Dr. MARC FABER from the Gloom, Boom, Doom Report. Good evening, Dr. FABER.
Yes, good morning to you.
Wanted to talk to you today about an interesting comment that China may have much more bullion, gold bullion, in their reserves than originally thought, several thousand tons. They might be preparing for a fully convertible currency. Just last week, there was some talk about a peg to the yuan on the futures exchange in China, the Shanghai exchange. Give us and our listeners today an idea of whether or not this sounds like a feasible reality.
Yes, I think this comment I would agree with and is appropriate. I think the idea of the Chinese is to eventually have a global currency, certainly with their trading partners. China is the largest trading partner with 124 different countries in the world, whereas the U.S. is only the largest trading partner with 74 countries in the world. So they have an interest basically to have one day renminbi. So with that comment, I kind of agree. Now, the question is, when will they implement it? And the question is, at what level? Because the Chinese economy is right now slowing down meaningfully. So they may first want to weaken their currency somewhat, not as much as the yen, but somewhat, and then introduce kind of a gold currency. Could be.
Could you give folks an idea of the implications of such a currency, given the degree of lost purchasing power after several decades of currency devaluation, particularly now underway in the Eurozone? Sweden now has a negative benchmark lending rate. I believe Denmark has imposed currency controls. Several other nations are considering negative interest rates. This is somewhat unprecedented on a global scale. Give us an idea of a gold currency, how it might shift the economic landscape.
But I can tell you that over the last 20, 25 years, the economic landscape has shifted dramatically. Asia has grown very substantially, and the U.S. and Europe, in terms of GDP per capita for the median household, in real terms, has declined. So there has been a huge shift in the economic balance from the West to the East and to emerging markets in general.
That's true. And we've seen this theme play out now for over a decade. However, I'm sure you've noticed that the equities market has remained robust now for going on 6 years following the credit crisis that was global in scope. Do you expect this theme to persist? Do you expect global capital to continue to flow in the United States and our domestic corporations to continue purchasing their own shares, boosting share prices?
I think it's a very good question. It is true that the U.S. market since 2011 has outperformed foreign markets meaningfully. But in the process, it has also become a very expensive market by historical standards. And my view is that if you go and talk around fund managers around the world, they will tell you the U.S. is the only game in town. I disagree. I think in 2015, emerging markets will outperform the U.S., by the way, as they have between the beginning of the year up to today.
Gold fund manager Egon von Greyerz noted recently that hyperinflation has begun to take hold in some of the peripheral nations throughout Europe and even somewhat in the United States. He's pointing to negative interest rates as supportive for asset prices, as we've already alluded to. There's really quite a debate still raging between the inflation camp and the deflation camp. Do you belong to either?
Well, inflation is a very complex subject. And I could talk to you for 1 hour what is inflation, what is not inflation. The fact is simply that over the last 10, 20, 30 years, the purchasing power of money has diminished very significantly. Just a few weeks ago, a Gauguin painting was sold for approximately $300 million US. In the 70s, that kind of painting would have been worth maximum $5 to $10 million, maximum, maybe only $1 million. So, and real estate, same. If you have properties in Manhattan, Park Avenue, Madison, Fifth Avenue, it's gone up exponentially in the last 10, 20, 30 years. So what you have in dollars today is much less than what you had in dollars 30 years ago. So in that sense, there has already been a lot of inflation. Now, when it comes to goods, because we live in a globalized economy, you can buy today maybe some tools and some consumer goods cheaper than 20 years ago. A hammer or a drilling machine or whatever it is. So, it's a mixed bag. But in general, I would say the typical household that hasn't had substantial assets is suffering. Household income for median, the typical household income in real terms is down. Wages in real terms are basically down. But the cost of living has gone up substantially, partly also because of this brilliant idea of Obamacare. So all I'm saying is the household sector is suffering at the present time. That's why retail sales are not taking off. And whereas the employment numbers look better, high-paying jobs have been replaced by low-paying jobs. In the world, in the 70s, we had high consumer price inflation. Now we have extremely high asset price inflation, which I expect will also come down at some point and turn negative, including the stock market and the bond market.
Under that scenario, one would certainly be searching for safe havens, and there are at least 150 million stock market investors in just this nation alone, about 1 billion worldwide, primarily through corporate stock plans and 401ks and other government IRAs and things of that nature. So this would have a global and systemic impact.
Well, first of all, you just said that there may be 1 billion investors worldwide. The global population is 7 billion. When I'm not traveling, I stay in Chiang Mai in the north of Thailand. I would say 99 to 98% of the people, they wouldn't notice if the stock market crashed. It's not of their concerns, because they don't own any shares. Now, if the property market collapsed, that would be more of their concerns because they own, like in the U.S., properties on credit. The asset market inflation has benefited very few people in the world. The Fed doesn't realize that. Now, when you ask me about this question, I would say, yes, if asset markets decline, it will have an impact because, say, the asset markets go up, the stockbrokers, Wall Street, the fund managers make money, then they go to restaurants and spend the money, and then the waiters get big tips and so forth. So it trickles down, for sure, but not to a meaningful extent, And my view is that if asset markets decline, actually, for the overall economy, it will be favorable. Now, coming to the corporate buybacks, corporations have a tendency to buy back their shares at high levels, not when the market is cheap. And just think of it logically. A corporation, they should invest in new businesses, new plant and equipment, but not buy back their shares. Basically, it's just to push up the share price. So the whole thing is a very artificial financial engineering that one day will end, in my opinion, I'm just saying my opinion, will end very badly. And as far as safe havens are concerned, you and I and your listeners, we don't know how the world will look like in 5 years' time. I would say we need, in absence of knowledge about the future, to diversify. So I would own some real estate. I would own some shares. I would own some bonds and cash. And I would own some precious metals. And this is what I do in a disciplined way.
Well, you certainly have some company there, particularly in that part of the world. China continues to import tons of gold through Hong Kong. We aren't certain of the stockpile. It's not regularly announced. They don't release a statement as some of the other countries in the world. And there's been some speculation lately. They may have accumulated much more than is widely accepted. In the event that at least a regional gold-based currency were to emerge, would you expect this to change the dynamics?
China increasingly trades directly with foreign countries, not in US dollars, but in local currency. I think that eventually China will have kind of a gold-backed currency eventually. So it could be 5 years from now, it could be 10 years from now, or who knows. My view is that the US dollar stay as a global currency are doomed. Now, in this scenario, you should own some gold. I wouldn't say that you should put all your money in gold, although maybe some people would say, yes, if you're that bearish about the world and the US dollar, you should put all your money in gold. But I'm not that courageous. I just diversify. As I told you, I would put about 25% of my money in gold. The point is, however, the following. The central banks around the world have engaged in money printing. And it's not at all a currency war. It is a coordinated effort by central banks that are run by some professors who never worked a single day in their lives in the private sector to kind of bail out the system. Now, this bailout will, of course, fail. And when it fails, the question is what will happen then? The central banks will, of course, blame people that own gold and assets and the rich people for their own mistakes. They will not say, we've been wrong. They will say, well, either we didn't do enough or because the rich people are hoarding money. So they'll go after the rich people and impose wealth taxes, and they'll go after the gold holders and say, okay, these are the evil people. They're holding gold. They're hoarding gold, and that's why the money doesn't flow into the system. So let's take it away from them. And so it's very important for owner of gold to know and think about where to hold the gold. The custody of the assets in future will be more important than the assets, in my view.
So then you would likely suggest that folks diversify globally their portfolio.
Yes, they should own some gold in physical form in Singapore or Hong Kong or in Asia, but not in the U.S., and most likely not in Switzerland and in Europe, because the Europeans are kind of briefcase-carrying people of the U.S. Canada is to some extent the lacquer of the U.S. If the U.S. says, okay, they will not take your gold away. They will say, okay, today the gold price is $1,200 an ounce. We'll pay you $1,200 an ounce, but you have to surrender your gold. And then they go to Canada and they say to Canadian Central Bank, you have to do the same. I think they'll do the same. And then they go to the ECB and say, you have to do the same. And these people without any backbone, they'll do the same. But in Asia, I doubt they'll do the same. So this is just a thought of mine.
I certainly share your sentiments. Turn the discussion here back to the domestic economy. We have seen some slowing numbers recently. The U.S. GDP grew at a more sluggish pace, was released last week, and there is some talk from the new Fed chair that they may hold the benchmark lending rate lower than expected. In other words, not pull the trigger on higher rates as many people have been bracing for. Do you feel that the precious metals, at least in dollar terms, are being held hostage as folks sort of wait to see what the Fed's true intentions are on rates?
I think the Fed, if anything, in its current composition, and don't forget, whatever you may say about Mr. Greenspan and Bernanke, Greenspan started to increase the Fed fund rate in 2004, June 2004, from essentially 0% or 1% to 5.25% in 2006. This time around, the stock market bottomed out in March 2009, 666 on the S&P. Now we're more than 2,100. Now, economic recovery officially began in June 2009. So we're more than 5 years into an economic recovery, and we have zero interest rates, and the discussion is about maximum. I'm repeating maximum, an interest rate increase of 0.25%. The whole thing is a complete charade. The Fed, in my view, is as clueless as anybody else is. They don't know. In my view, the Fed will not increase interest rates in 2015. So the whole stock market charade will continue to go on for a while, but increasingly, some people have second thoughts. They think, how does it all add up in the long run?
There's been considerable talk recently about the Eurozone, and a Greek exit has been on many investors' minds. Some folks are saying that this appears to be an unraveling or leading to an unraveling of the Euro region as a unified economic viable entity. Whereas others say, well, the United States hasn't even addressed many of the issues that they are working through.
Well, my view is this is more a political issue than an economic issue. The neocons in the U.S., as much as I dislike them, but the fact is they would like to control the whole world. And one stepping stone is to control Europe and not let anyone get into Europe. So, say, a Greek exit would open the door for Russia, which has already taken control of eastern Ukraine, and rightly so, because they were attacked by the U.S. and the neocons that financed the uprising in Ukraine and financed fascists in Ukraine. And they don't want Greece to leave the EU, because then the Russians could come in and help the Greeks or the Chinese. And so it will go with Italy and Spain and so forth. So in my view, the EU for now will stay in place. In time, it will probably weaken the economy of the EU, and maybe they'll even go bust.
Returning to your earlier thoughts about artwork, the comparison increase in prices, for instance, the piece you spoke of would have sold for maybe $10 million back in the 70s. And today, as much as $300 million. You know, it doesn't even take a pocket calculator to realize that's a 30-fold increase. That would seem to indicate that there might be a hidden world of price inflation that could erupt almost like a forest fire.
I would hold about 25% of my assets in precious metals. I don't know whether silver will go up more, or gold, or platinum, or that I don't know. But the fact is simply, I want to have some assets outside the banking sector. Because the banking sector is run by an academic mafia. They are the destroyers of the purchasing power of money. The professors at the Federal Reserve, they don't care about ordinary people. They are not even independent. They are ruled by someone that tells them, you do this, you do that. And that is largely the banking cartel. And I tell you, I feel very sorry for ordinary people. And I feel very sorry for young people, because America became a great nation in the 19th and 20th century, up to, say, the Vietnam War. In the 50s, the U.S. was way ahead of any other country in the whole world, way ahead. And there has been not an absolute, but a relative decline. This is a fact. The evidence is from all kinds of statistics, from real wages to, say, the relative importance of the U.S. within the global economy. Now, other countries have grown dramatically, but all I can say is I would hold some precious metals, because all the central banks in the world, it's not a currency war. This is an agreement among academics and professors that do not relate to the lives of ordinary people to print money. The baton is passed on from the U.S. to Japan, and then to the EU, and to the Bank of England, and eventually to China and so forth. They all print money, and the purchasing power of money will continue to decline.
Your wisdom is certainly appreciated here. Your passion for the homme moyen, the bourgeois. I think history has made it very clear that when the powers that be separate themselves in their ivory towers from the everyday individual, the end game is not pleasant, putting it euphemistically.
And I'd like to add one final comment. Mr. Greenspan, who I've known from the 1970s, was a highly intelligent person, still is a highly intelligent person. But he admitted to me that the Fed is not independent. He said to me, I never said the Fed was independent. Number two, Mr. Bernanke was a perfect academic, but was basically clueless about the economy. Then he printed money, and the media and, of course, the financial sector called him a hero. Well, he led the U.S. into financial crisis in the first place. After this, called a hero for saving the system. Yeah, was it worth saving? This is the question. Number three, Miss Yellen was, in the years 2004 to 2009 or 10, she was the president of the San Francisco Federal Reserve, which was supervising California, Arizona, Nevada, and some other states. I'm not sure whether it was also Miami. But anyway, in her districts, the real estate market collapsed the most. The most. She wouldn't see a bubble and is now the chair of the Federal Reserve. And I think that we will have more volatility this year.
We wish you continued success.
Take care. Bye-bye. Thank you.
Here is your mining quiz for the day, compliments of GoldSeek. Which company has the largest undeveloped gold reserve in North America? Seabridge Gold. Now, which company has the largest undeveloped copper reserve in North America? Seabridge Gold again. Seabridge has more gold reserves than Kinross, Yamana, and Agnico Eagle. Last year alone, Seabridge added 515 million tons of new inferred resources containing nearly 6 million ounces of gold and more than 6 billion pounds of copper at their giant KSM project in British Columbia, Canada. Now they are drilling at KSM again with multiple rigs in a 25,000-meter program. Find out more by visiting www.seabridgegold.net. Traded on the NYSE, symbol SA, and the TSX, symbol SEA.
GoldSeek employees may or may not own shares. Nothing contained herein should be construed as investment advice.